Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I provide valuation and mediation services based in St. Louis, Missouri. Today, we're actually kind of building upon a prior discussion that we had, but we're going to be discussing the pandemic economy and divorce with Josh Shilts and Patrick Kilbane. Josh's practice is really focused on complex financial matters and disputes. He's a frequent lecturer on forensic accounting topics and has been involved with hundreds of forensic investigations dealing with matters involving personal and business disputes, as well as the identification and mitigation of fraudulent activities. He's also provided expert testimony in commercial and family matters surrounding business valuations, economic damages, fraud, and other disciplines having to do with accounting and economics. He's a forensic valuation expert and offers tax advice in the state of Florida. Pat, on the other hand, is a wealth advisor with nearly a decade of experience in helping clients coordinate their wealth management plans. He's also general counsel for Ullman Wealth Partners. He is the director of Divorce Advisory Group, where he assists, guides, and supports clients before, during, and after they begin the divorce process. He helps high net worth clients make financial decisions at all stages of the divorce process by using his family law experience, his wealth management experience, and his certified divorce financial analyst designation.
We've been involved in more deals than we ever have. And I agree with you. I think there's several factors. You have a baby boomer age group who have been through the Great Recession and another pandemic, and they're saying, okay, I'm done, kind of a situation. So what the pandemic did, hindsight's always 2020, is it almost gave us a shot of adrenaline into the future. Look at how we've become. I would guess that everyone living in this country is a better user of technology now than they were 18 months ago, right? So in our business transactions and whatnot. And you're right. I knew, I was believing that there was going to be businesses who were better capitalized, who saw the pandemic as an opportunity to expand operations, to acquire not necessary, acquisition of competitors, acquisition of complementary assets. I'm seeing more of that moving on, and that's where that scenario analysis is coming into play. So it's different there on a divorce, but it's a good question to be asking right now for anyone who's going through a divorce. Has your business been? Have you been approached about an acquisition? Because it's going to tell you potentially if there's some sort of a letter out there. I want to see that because that's the open market telling me a price right now.
Exactly. I would also think, and this, gets us off topic slightly, but, the potential legislation around increasing capital gains taxes and whether that's going to be retroactive or not is also a really, really significant, consideration that I'm seeing.
Big time. Listen, the pandemic, now that we have the 2020 data, let me tell you the good use of it. It's going to tell you a lot about management and their capabilities and knowledge, Melissa. And that's what I think you're getting to is. So that's helping me in my CSRP analysis. It's helping me with projections, forecasting, the management strength. But to Pat's point, as a valuation analyst, I'll tell you what the two number one topics I'm thinking about that I think are going to have an impact. It's inflation and the equity risk premium, the risk rates, but also to piggy off exactly what Pat is talking about is the taxes, right? Because they're talking about corporate rates, which has a direct impact to how we value. We went through it with Tax Cuts and Jobs Acts. Built-in capital gains within businesses, how we handle those potentially in a valuation context. The transfer is going to potentially be costlier in an asset sale. So do you start seeing people say, instead of an asset sale, which we've traditionally recommended to small, medium-sized entities, We go to a stock sale. Well, all right, we'll do a stock sale, but now we need to do more due diligence because we're acquiring. So that's all off of the tax side of it. So I agree with Pat that the tax and inflation and what the Fed is going to price at are things that are going to impact valuations, i.e. pricing.
Mm-hmm. Well, and I think part of this issue is that when you start to combine uncertainty with divorce and unknowns and inconsistencies, and this was up and this was down and this was up, it creates this mistrust. And now it's like, well, then he contrived it and she did this, and they're making it look bad. They're making it look good. But the reality is, I don't know. I think on a personal level, things have gotten bad for groups and people at an individual level, but at a business and even certain industries, right? But those industries already had issues to begin with in a lot of capacities, low margins, they already had some issues anyway. But what we're seeing,
distressed.
Right. But businesses,
this is what I talk about is distressed businesses. And that's why I think the pandemic was a shot of adrenaline that maybe moved us forward as a society a couple of years. When we look back in 10 years from now, what will we say about the pandemic? God, we got better at business? Maybe.
I agree with that wholeheartedly.
Well, and it may not be getting better. It's that, I sort of feel like some of this is like survival of the fittest. Did you know your market? Did you know your customer? Did you know, were you just in a space because you could make some money there? It's really going back to some people that were in business as a passion, that they really loved it, that they were able to maneuver a little bit better, as opposed to if somebody was just out there trying to grab cash and that sort of dwindled. We did see those businesses go away, right?
I have a perfect example of that, where I just got done with a divorce case and evaluation. 2020, there was a loss. So they said this company had absolutely no value. Let's not even get into goodwill and all that, right?
Right.
Let's just, because it didn't make any money. Well, I was able to show that, yes, they had a loss, but let's talk about these expenses. First of all, let me tell everyone who's listening, there was a 30% increase in revenue. So it was consistent with its prior 3 years. Consistent 30% trends. And guess what? It was even higher during the pandemic year. So we started digging into the expenses and what are we really doing here? He was in expansion mode. So he was buying up these little things, to your point, right? From a tax perspective, it looked like there was a loss. But what we really found was acquisition of other assets. So when I looked at that and I looked at what is the base asset and what does the base asset mean on a gross profit percentage when we put it in the proper period for measurement, turns out this business was not a $0 business. You know what I mean? So you can see the reverse of that too, where instead of them expensing it in investments, they were expensing it in stupidity.